Jeffrey, great to see you again.
It's good to be here.
We were talking with Scott Wren about how, at least for the stock market, maybe it's seventh inning with a couple of outs. But when you look at the global economic cycle, where do you think we are? Are we in the middle? Are we in the beginning? Are we at the end? Okay, well, forget beginning.
I mean, in terms of this recovery, I still think it has some legs. I mean, I'm not smart enough to know whether or not we're in the seventh inning or the fifth inning, but I think when you have coordinated central bank easing, that is a certainty. Basically, you're basically saying we don't want you to save money in banks and depository institutions. We want you to put money to work in investment. And I think that's what you're seeing. I mean, we see it all the time. Folks are barbelling their portfolios. They may carry extra cash around, but they're looking at riskier investments and they're buying equities because there is no alternative if you're expecting to make a rate of return. And that's just not individual accounts. I think that's pension funds. I think it's sovereign wealth funds. And so, are we in the fifth inning or the seventh inning? I don't know. I'm looking at central bank activity as a good indicator.
So one could make the argument that this sort of forced barbell that people have been pushed into, where hold a lot of cash so they have liquidity and they're protected, while also going pretty far out on the risk spectrum, has been kind of the defining characteristic for the last 10 years, arguably, post-crisis. And what you're saying is there's just no sign that that's changing yet.
No, I mean, I think if you're looking at, for example, in the U.S., if you're looking at super low unemployment, who would have thought that we'd be in an easing cycle with unemployment at these levels?
Right.
Why is that? And I think people are looking out and saying, okay, well, I'm pretty sure I've got a job. I may not be like ebullient about where the world is headed, but I'm gainfully employed. And so I got my cash nest egg just in case things go crazy, but I can probably afford to take a little bit of risk. Yeah. And I think that's what you're seeing. I don't think it's anything more complicated than that. We're living in a time now where, the average American actually has more exposure to the U.S. financial market than maybe at any other time in history. And people don't focus on that because they don't really look at how much U.S. equities are owned by pension funds. Yeah. So when was the last time we talked about the fact that pension funds were underfunded? Been a while. Why? Because equities have rallied, right? So they're less underfunded than they used to be. And so as the boomers move into their twilight years, their balance sheets, if you include their pension fund assets and their 401ks, have never really looked better. And that's a very different dynamic than maybe the one we were talking about 5 years ago.
Right.
Right? And so I just think there's a lot of reasons for the U.S. equity market in particular to continue. Certainly we're in an election year. The president would like to see that happen. Right. And we're getting that central bank a bolster, even though we're in a low rate.
Well, let's talk about some of the specific issues out there. Obviously, we had the signing of the Phase 1 trade deal, which, depending on your perspective, is either the most momentous thing to happen to trade or not. But one thing that we've seen over the last year and a half or so that we've been through this is sort of this decline in CapEx spending, sort of a little bit of tamping down in CEO sentiment. Do you think that with the resolution, or at least the first phase of this resolution in the trade, that we'll see an uptick in that sentiment? And long term, are we going to expect sort of a fundamental change in how we view companies that are multinational companies that are exposed to the trade environment?
That's a great question. So CEO sentiment, I think has probably improved here because by and large, it looks like people are laying down their arms for the time being in the trade war. Though it's not like we're going to roll back tariffs. So we're still going to be living in a world where we have significant amounts of goods and services under tariff on both sides. So, and I think, the Trump administration has said that it's going to sort of take up situations with Europe. Europe's got to go through Brexit. Yeah. So it's not exactly as if it's so hunky-dory that CEOs can stop worrying about putting capital to work. CapEx is going to be, I think, tamped down a little bit by some of that uncertainty. It's good. On the whole, it's better that we have Phase 1. But Phase 1 is a very narrow set of agreements. It's better to have it than not to have it.
Right.
But it's not like all of a sudden we're waking up and CEOs are sort of ebullient all over again. And I don't think you're going to see this massive upspend in CapEx.
All right. Well, I'd like to hear what your clients are doing. Are they getting ready to spend? And if so, on what? I mean, would they be looking to buy their companies? Would they be looking to build out their facilities? How are they planning to deploy cash and put some money to work?
Yeah, I think. So it depends on the industry.
Corporate clients.
Yeah, I think it depends on the industry.
Okay.
But I do think that corporate balance sheets, people have a lot of capital to put to work. I think there's definitely some concern, and I've heard in a number of industries that asset prices, particularly stock prices, or the value of people's equities, particularly in the private market, is high or maybe overinflated. I don't know when that goes down, because everybody knows that private equity has a lot of money to spend, and everybody knows that our corporate clients have a lot of money to spend. They're just waiting for prices to come in. Well, generally speaking, that has to give, right? Those private market valuations and sometimes public market valuations reflect the fact that there's a lot of cash on the sidelines. So I think people will be tactical. And I think that's really the watchword. If there's an asset that you have to have, that you think you can demonstrate significant growth or take out significant costs to drive your bottom line, you should do that. And you shouldn't really wait for prices to come in. And those companies that are seeing those strategic opportunities are taking advantage of it. Our M&A backlog at Cowen has actually never been bigger. So we continue to see significant activity going on in that